Hey everybody, Leticia here, coming to you for another edition of my weekly Money Matters webinar. And today's topic is income for life. I didn't have a chance to do my little video introduction earlier today, but that's the topic of conversation today, income for life. And no, I'm not talking about the famous lottery, but we are going to be talking about a certain type of investment that creates predictable income for life. Many people in today's day and age are, well, what can I say? We are living in some very uncertain times, and getting any kind of guarantees on your investments is becoming a thing of the past, unless you're willing to keep your money in GICs, and that's something that we all know doesn't even beat inflation. So what I'd like to discuss today is a unique offering from one of the companies that I work with, and you'll soon find out who I'm talking about. So as some of you know, I work as an insurance and investment advisor, and as through my affiliations with the various insurance providers, I do have access to certain investment products that are unique to the insurance industry. And this is a very interesting product that I'm going to be talking to you about today. And let's see why we're even talking about that. So once again, we're going through very uncertain times. I have a few slides with you that this company was nice enough to share, and I will be sharing those with you. As usual, if you have any questions that come up during my presentations, please put them in the comment section below, and I will periodically look at the comment section, and especially at the end, okay? Thanks everyone for watching, and let me share my screen, okay? One second. So by the way, before I do that, today's topic will probably be most of interest to those of you who are approaching pre-retirement or retirement age. And I know that even the concept of retirement is becoming, it's currently evolving. You have a lot of people who are self-employed, or who go years going self-employed or doing contract work, and it's not the old school way of working where you're working for the same company for so many years. So this is yet another reason why I think a product such as the one I'm going to show you today is an opportunity, especially for people who have been spending a portion of their careers being self-employed, not benefiting from those guarantees that were traditionally offered by large employers or by the government. If you're a government employee, you still have access to a lot of guarantees, but for the rest of us, we kind of have to create our own retirement income streams and be more proactive about planning for our future. So this is, I'm going to share my screen with you guys again. So the company I'm referring to is Empire Life. They are one of Canada's top 10 insurance companies on the life and health side of things, and they also have a large investment division. And this is offered through their investment division. I'm gonna see if I can, okay, I hope you guys, I am screen sharing, good, okay. So 1610, a recent survey of pre-retirees. So these are people, I would say, ages in their 50s, 55, approach retirement age. 1610 would like to have a guaranteed income for life. However, the reality is that 1 in 2, unfortunately, expect a lower standard of living in retirement than they currently have. And don't even get me started about the added uncertainty that the current COVID crisis is creating, because as we all know, we're not just facing a health crisis, but we're also dealing with financial repercussions, such as potentially increased inflation. You guys know what I'm referring to. So let's talk about even prior to COVID, these were some of the trends that we were facing. We're facing, and this is in Canada, in the US as well, an overall aging population. For the first time in history, we have more seniors than children. The longevity. So even for any kind of investment that you're considering, longevity risk, especially for retirement purposes, longevity risk was something to be taken into account. In other words, the risk that somebody may outlive their savings and investments. And of course, those of you who are real estate investors have other types of plans for that. And of course, real estate can play a part in that. What I'm going to show you today is something else to keep in mind, something that perhaps you may want to use as a diversification strategy to ensure a certain level of guaranteed income for yourself and perhaps your spouse in those retirement years. And you don't have to be, as of yet, at retirement age for today's conversation to apply to you. But again, if you are anywhere close to pre-retirement years, or even if you have a loved family member that this would apply for, you may want to listen in. So what else do we see? We have an increasingly female aging population. Women in general live longer than men on average. So oftentimes, more often than not, when there is a passing of one of the spouses, it's more often than not is the woman who is the survivor. So again, we're talking about higher longevity, not by much. So current stats are that for women in Canada, average life expectancy is 86. For men, it is 84. If you have a senior couple that have reached age 65, there's a 1 in 2 chance that either one of them at least one of them will make it to age 90 and beyond. So those are just some of the considerations. So we have an aging population. Now, we have less income support from traditional sources. So again, back in the good old days, if you could refer to them as that, I mean, that's questionable, but essentially there were these things called defined benefit pension plans. So in other words, you contributed into a certain pension plan that was provided by an employer. And at the end of the day, you were guaranteed you knew exactly how much you were going to get in retirement age based on the whenever you chose to retire. So those plans are almost a thing of the past. We still have, and currently only about 24% of the Canadian workforce is even covered by an employer-sponsored pension plan. So there's less of that happening. So, and when employers do offer pension plans, it's often the type of plan where you're making contributions, and then I guess you're going to see what you're going to get at the end based on the performance of the funds that you're putting your money in. So what else? Well, we have all heard it that if you want to get higher returns, it's often linked to higher risk. People who are nearing retirement are less likely to be taking aggressive risks with their capital, because obviously they don't want to lose it. They've worked all their lives, they have a certain nest egg. To the extent that somebody in that age range has a nest egg, people at that age range are usually wanting to, first of all, preserve their capital, and if they can get some guaranteed income out of it, I think that would just be bonus. So again, typical retirement planning has to take into account things like longevity risk, inflation risk. Of course, we have, prior to this COVID thing happening, we were in a relatively stable inflationary environment. I mean, we were told 2 to 3% per year. That was the official inflation rate. Many of us suspect that the actual inflation rate is a lot higher than that, and we all know with the amount of money printing that's going on, that's also a concern. Market risk, of course, there's something called, we all can understand what can happen if somebody is investing, let's say, in mutual funds or any kind of market-based investment, and all of a sudden we have another 2008 happening. So any kind of financial crash that would cause the value of those market-based investments to, hit rock bottom. And if you were relying on those investments to create a retirement source of income, all of a sudden you have a lot less to draw from. So that's always a risk. And again, people who are in their pre-retirement stage of life usually will gravitate towards, safer type investments. And then we also have something called sequence of returns. And again, this can affect people at any stage in life, but especially if you were actually a diligent person who started your investing career, your investing journey earlier. What this says is that negative returns in the early years may exhaust funds at much earlier age. So because of the power of compounding, if you've actually had negative returns in the early years of a market-based investment, the power that your money has to grow later on is greatly diminished. And again, unfortunately, that's not something most of us can control. So what kind of solution can we be talking about? So as mentioned, the solution I'm going to talk about is offered by Empire Life. They're one of Canada's top 10 insurance companies. They have a strong life and health insurance division. And again, they also have what we call, the investment division that offers segregated funds. And I had a session a few weeks ago about what segregated funds are. Essentially, it's similar to a mutual fund, except it offers additional guarantees. And because they are an insurance company and they're governed by the Insurance Act, the type of products that they offered, you're not going to find them at the bank. So what we're going to be discussing today is strictly something that can be offered by insurance companies alone. A number of years ago, there were a number of companies in the marketplace that offered this type of investment. As of last week, Empire Life is currently the only company that will still offer these sort of guarantees. And you're going to see what I'm talking about as we go along. And again, I think the reason many insurers have pulled out of this marketplace is because they realized that it wasn't profitable enough for them to keep offering such generous guarantees. And you'll see what I mean. Okay. Okay. So the name of their plan is Class Plus 3.0. You don't have to worry about that. That's just the name of this particular investment product. So the idea, how the product works is that you could be and typically where it makes sense to even consider this sort of plan is ages 45 plus. So you're definitely in your pre-retirement years. You could say, you're technically 20 years away from traditional retirement age. And again, I recognize that how people work is definitely changing. And what I like about this program is that it actually allows for some flexibility, and you'll know what I mean. So for example, somebody as early as 45 could consider this plan. Now, if you're younger than 45, it may not make sense. What you want to do then is get into either some other types of investments, including potentially with Empire Life, they offer a strong suite of what we call segregated funds, traditional segregated funds that still offer certain benefits, but for the purpose of this particular product, it makes sense to be 45 plus. So let's say you're 45 plus, you could actually start into this plan. Anybody 45 plus could start into this plan with a deposit as low as $10,000. Well, as low or as high, but that is the minimum to get started with this program. So that, and then you enter what's called the accumulation stage of the plan. So you could be in the accumulation stage. You could start with an initial deposit of $10,000. Now, you don't have to make any further deposits beyond that point in time. Every year, I'll explain to you in a second what happens. So with that $10,000, you could choose to make ongoing monthly payments. Now, the plan can be set up either as a registered plan, so you could set this up inside your RRSP or inside a TFSA, or you could strictly set it up as a non-registered investment, okay? It depends, and the decision on that will be made based on what other investments you may have going on. Does it make sense for you to hold this inside an RRSP? This is something myself and our specialist at Empire Life can help you to decide. So bottom line, you enter the accumulation stage of the plan. So if you're somebody who is not yet at retirement age, you're not looking to draw income yet, you're simply wanting to create a future income stream for yourself. So you have the option of starting the plan, making or not making deposits. For every year that you're not pulling any money out, Empire Life will give you a 4% bonus. Now, the bonus is actually a nominal bonus. It's not an actual bonus. How that works is that as early as age 55, you can now start pulling that, what's called lifetime withdrawal amount, okay? So this plan has the accumulation stage, and then they have the income phase. The income phase is when you are now in a position to start pulling money out of the plan, okay? So you're now age 65, or even as early as age 55, you can enter the income phase or the withdrawal stage of the plan. So what happens is, if you started this plan at age 45, let's say with a $10,000 or $100,000 deposit, however much you are in a position to contribute, for every year leading up to the year in which you actually start making withdrawals, Empire Life pays you or assigns to you a 4% nominal bonus. They call it an investment bonus. So it's a guaranteed return of 4%. Now, you may find that the market value of your investment, especially if you're invested in something that's market-based and they allow up to 80% equity exposure, will actually be higher than that, okay? So by the time you get to age 55, let's say 55 or 65, when you're actually ready to pull money out, the market value of your investment may be higher than that, and we would hope it's higher than that, right? Now, what Empire Life will base the withdrawal amount for, and they call that LWA, or lifetime withdrawal amount. So it's a set amount that you will get for the life of the plan, as long as you're not making any excess withdrawals. So if you all of a sudden decide to cash out your investment, well, you've just killed your nest egg, right? But essentially, as long as your funds are still in there, they guarantee, starting at age 65, 4% withdrawal. Now, again, leading up to that point in time, what they will base the withdrawal amount for, so for every year that you're not pulling any money out, they reward you with a 4% bonus. So by the time you are ready to start pulling money out, let's say at age 65, the withdrawal amount will be considerably higher than what your initial 10%, because they have been keeping track of 4% per annum every year. And then at age 65, it's time for you to start withdrawing. So at age 65, let me show you what happens. Okay, so they give you a guarantee as to how much you're going to receive. So if you were to retire at age 65 and start pulling out an income at age 65, it would be 4% of that. They call it the income base. The income base is whatever money you've deposited into the plan plus that guaranteed 4% that they've been adding to your income base every year. Okay. The nice thing is, now, as you can see, they have the option of, yes, it says annual automatic increase resets. So depending on how old the client is at the time when they choose to start drawing an income from the plan, they have certain percentages. So at age 65, it's 4%. If it's less than age 65, so as you could start pulling an income as early as age 55. If it's age 55, the income you can draw is 2.85%, and then it grows every year. And then if it goes past age 65, the percentage on an annual basis will be higher. Okay. The income-based reset automatically every 3 years. So let's talk about that as well. So that's right. Okay. Okay. So as mentioned, the for younger clients, so if you're younger than 65, it's less than 4%. Any amount past age 65 grows. So I believe by age 80, you're looking at about 5.29% of whatever that income base is. So every 3 years, based on the market value of the investment, if the market value, so here's the nice thing about this plan, right? So we spoke about how there's something called, okay, right, okay, so age 35, okay. They tell you how they calculate what the income is. Right, okay. So in this example, you can see how in some years, the actual market value of the investment may have gone down. But what Empire promises to do is that your income base will never go down. So that initial amount that they base your 4% on, and in later years, the older the client is, if you're 67, 68, 69, the older you are, the higher that percentage income is. Even if the market value of the investment has, in the meantime, gone down, maybe there's been a 2008, they will not take that into account when paying you that 4 or 5%. They will look at the last calculated value of the income base. And now every 3 years, there's an opportunity to evaluate that. So if 3 years into the plan, all of a sudden the market value is a lot higher, they will pay you the higher of the market value or the last income base. So every 3 years, there's a revaluation. Once you start the withdrawals, every 3 years, there's a revaluation of the market value of the investment. If the market value has gone up, that becomes your new income base. And that 4% or 5% percentage will be based on the new value, okay? Okay, now we spoke about the fact that, again, we are, the concept of retirement is changing a lot. And what this slide says is that, 56% of workers retired earlier than planned. Now, this may be for many different reasons. It could be perhaps due to a disability. That's something we could discuss in a future session, the concept of disability and how that impacts somebody's, how that can impact somebody's finances. Or it could have been just, the nature of work changing so much, people becoming self-employed. And so again, we spoke about this, that you can start receiving an income as early as age 55. And this shows you how, for example, if you start drawing income at age 68, the lifetime withdrawal amount gets set as 4.15. But every year, the older you are, the higher that amount is, okay? Okay, now let's say, and I think we have an example of this, okay? I'll show the example quickly, but this is another example. We have this couple, they are currently in the accumulation stage. They have the possibility to grow their savings. Now, keep in mind, what I like about this plan is that it's very flexible. So for example, you could deposit your $10,000, $15,000, $100,000, whatever amount you choose to deposit into a portfolio that has some equity exposure. So you have the potential to grow with the market. If your portfolio, if things go well with your investment, then you decide, you know what, things have gone so well with this investment, I don't need this income guarantees anymore. You can pull your money out at any point in time. Okay, now, of course, if you're inside a registered plan like an RRSP, there are consequences with pulling money out of your RRSP before retirement age. But bottom line, you are not locked in. It's not like you're giving the money to the company and then that's it. You have to continue with the program for the rest of your life. So I like the flexibility, the fact that you can, but at the same time, should you choose to continue with the program, they give you this nominal bonus of 4% per annum, okay? And then every 3 years, depending on what the market value is, if the market value has gone higher, they will base your income at the end of the day based on that, okay? Every 3 years. If it hasn't, then they still look at the worst case scenario, which is whatever you deposit plus 4% nominal per annum, okay? They talk about a death benefit guarantee. So because this product is offered under a segregated fund chassis. Is that the word? It also comes with something called a death benefit guarantee. So in the unfortunate scenario that the client were to pass away before they even have a chance to benefit from their investment, they will get the highest of the market value of the investment. Not they, but rather their loved ones, their family, whoever inherits their wealth, would get the highest of the market value, or there's a 75% guarantee on the initial contribution. Okay, and depending on how long you've been contributing, it could apply to some of the monthly contributions as well. So there is also some downside protection, which again is unique to segregated funds. It's unique to life insurance companies. Mutual fund providers such as bank cannot give you the sort of downside protection, at least on the back end. So in other words, if the market value of a mutual fund has gone to 50% of what you put in, and let's not say you, but that client put in, and the client ends up being so depressed, has a heart attack, what have you, their estate would only get 50, whatever the market value is at that point in time. Whereas with seg funds, you have, in this case, that 75% guarantee of the initial investment. It's better than nothing, okay? There are some seg funds out there that offer even 100% death benefit guarantee. This one, again, because of all the other benefits it offers, it stays at 75% for the death benefit guarantee. Okay, so yeah, let's talk about this client, okay, potential client. She's 50 years old, looks good for 50, okay, invests $250,000. She's done well for herself. She's got already a bit of a nest egg at that age. The bonus that I told you about during the accumulation stage applies for a maximum of 20 years, which is why I said to you that in most cases for the client, it makes sense if their target retirement age is age 65, they would benefit. A client 45 plus can benefit from these 4% accumulation bonuses every year. But if it's a client younger than that, they wouldn't, benefit as much. So in this case, the client started at age 50, so she benefits from the 4% bonuses. She starts drawing income at age 65. So the income base has grown from the original 250, in this case, to 537. So her lifetime withdrawal amount is now 4% of the 537,000. Okay. Again, talking about the income now scenario, we talked about the fact that every 3 years, if that's right, yeah. So every 3 years, if the market value is higher than the previous income-based guarantee, the income base will now be reset to the higher market value. Okay, we have another sample customer here. He's 60. He's the type that he doesn't need the accumulation stage. He's already accumulated his savings, his investments via other different vehicles. Maybe he was in a mutual fund portfolio, maybe he was in a traditional seg fund portfolio, and now he is retirement age. He's wanting to start pulling money out, and like many retirees, as we discussed, he is looking for some sort of income guarantees. He wants to know what he can count on in his retirement years. So he chooses to put his funds into this sort of plan. Based on 400,000, his annual income from that would be 16,000 at age 65. And again, it says here in an up market, again, they call this 4% annual income per year for life. Okay, that's why it's called income for life. They call this the lifetime withdrawal amount. Okay, now keep in mind, he gets to age 66, 67, that 4% grows every year. And we're going to talk about something that's even more interesting in the next few slides, which is really advantageous for retirees. And I'm actually amazed that the company has been so generous with this offering. In a down market, the lifetime withdrawal amount will not decrease. So again, even if the client's initial 400,000 has all of a sudden gone to 250,000, nope, the company has committed themselves that they're going to give that 16,000 annual to this client. And again, the client is still allowed to have equity exposure, which would allow for every 3 years for that reset to happen. Okay, in the market value of the investment. Again, we spoke about the fact that the new retirement landscape. There are people who are semi-retired, so they are in that transition from employment to retirement. They may choose to explore self-employment. And there may be some people that are at a stage where, as this slide says, they may need to augment employment earnings. So they may be working part-time or doing some self-employment work, and they need to supplement that. This type of plan allows for that flexibility. Again, as early as age 55, the client can start pulling money out. And just to give you an idea, it also allows for on and off. So for example, in the case of this client, he was, he said, oh, well, I'm going to retire at age 65, started drawing an income from the plan, as we discussed, and getting the lifetime withdrawal amount that would apply based on age 65. It would be less than 4% because at age 65, you have the 4%. But bottom line, he starts drawing an income, and then, age 63 to 66, gets a contract job. He doesn't need this additional income anymore. You can literally put a stop on the plan. You're not forced to keep taking it. Now, there is something that applies to RRIFs, Registered Retirement Income Funds. I'll explain to you in a second what that is and where that fits into play, where the government, after a certain age, the government forces you, but that goes after age 71 when you're actually, forced to withdraw. So as you can see in this case, if the client is not in the years that he's not pulling an income, he goes back on that 4% automatic accumulation to his income base. So by the time he comes back on the plan, he's now drawing from a higher potential income base. Okay, I don't want to confuse you guys too much. So yeah, the interesting thing about this is, as this slide says, you win no matter how the markets perform. So in the up markets, the income-based resets every 3 years to lock in any gains and could increase your income, because all of a sudden you're not basing it just on your initial investment, but you're basing it on the new higher market value of the investment. In the down markets, if you have been in the accumulation stage, you've been benefiting from that 4%, that applies on your initial investment, regardless of what your initial investment may have done in the meantime. Okay, so these are very sweet guarantees. And just so you have an idea, currently, as I mentioned, all the other providers in the marketplace that were offering even similar type of plans to this, neither one of them was willing to commit to this, let's say in this case, 4%. So the bonus was always tied to the interest rate, to the bond rate. What Empire is offering, they already had the leading product in the marketplace, in my opinion, when it comes to this sort of product, and now they're actually the only one in the marketplace. And I want to tell you guys, like, if you think this could be an option either for yourself or for any of your loved ones, I would encourage you to take advantage of this offering or to explore this sooner rather than later, because, like I said, one of the other leading providers of this similar type of plan has just left the marketplace as of last week. So we don't know how much longer Empire is going to be offering this generous plan. I am a licensed advisor with Empire, and should you have any questions, you're welcome to reach out to me. You can reach out to me via direct message or email me at info@mavenwealth.ca, and we can be in touch. Okay. Anyway, that was an aside. You do have certain options when you set up the investment. You are given a large range of funds that you can choose from. So based on your own risk profile, some clients may want higher equity exposure than others. And again, the equity exposure is really, to me, I only see the upside, because if your intention for the plan is to eventually draw income from it, okay, you can't really lose with this plan. So the higher the equity exposure, the higher the potential for that base to reset to a higher value. Now, if you're going to be, but of course, there is the risk that your investment, if you have equity exposure, there's always that risk that it could be affected by the markets. But in this case, the company gives you this protection. It's your initial investments is protected plus 4% per annum for every year in which you're not pulling money. So it's really, again, says it is for clients who are conservative. And again, anybody who is in their pre-retirement years who has accumulated any amount of nest egg, I can't see people at that stage in life being very careless with their money, because as people approach that stage in their life, they recognize, like, well, I'm not going to have, if I exhaust my nest egg, I don't have as much time as I once had to reaccumulate. I mean, so it makes sense. It makes sense that a client at that stage in life is looking for guarantees and is looking for protection of capital. And this is what this plan offers. Again, now the only risk is that if you later change your mind and you have been investing in something that has exposure to the markets, obviously and you decide to withdraw the funds, well, you're withdrawing what the actual market value is. The guarantee only applies if you actually stay in the program and you get to that retirement age, you get to that age when you're wanting to withdraw money, and then that the initial investment plus the 4% nominal bonus, that will become your new withdrawal base, your new income base, they call it. Okay. We spoke about that. And again, if you happen to be investing outside of a registered vehicle, so outside of an RSP or a TFSA, of course, with registered investment vehicles, any growth is tax sheltered. Okay. But if you're investing outside in a non-registered investment, as you can see, income is tax efficient, mainly return on capital and capital gains, because again, we're talking about funds that have potential exposure to the market. So you can see that. Okay, estate planning benefits. So again, because this investment is offered under the chassis of a seg fund, it offers the same benefits as any seg fund, segregated fund, such as bypass of probate. So the survivor, if you, whoever you name as your beneficiary, will receive the funds almost immediately. So they don't get tied up in the probate process. Now, this is the very interesting thing. So in Canada, if you're somebody, most of you have heard of what's called an RRSP. It's like an envelope where you deposit investments and you do that with the intention that eventually you're gonna be withdrawing funds once you get to a certain age, typically age 65, retirement age 65 or older. Now you can, while you could choose to withdraw funds from an RSP, that's not the way most people do it, because the RSP is seen as an accumulation vehicle, whereas what's called a RRIF, RRIF, Registered Retirement Income Fund, it's actually what the RRSP turns to when you get to that retirement age, when you start actually pulling money out. So the government requires you to turn your RRSP into a RRIF maximum at age 71, but you can choose to do it sooner. And it's something very interesting about the RRIF. So the CRA sets out something called the RRIF minimum, the minimum withdrawal amount. So they say, well, you've accumulated $500,000 or whatever amount of money in your RSP. You've now turned your RSP into a RRIF. Now you're going to start drawing income. And again, you can defer doing so all the way to age 71, but then after that, they basically make you convert your RSP into a RRIF. It's just how these programs are designed. So based on whatever age you've turned your RSP into a RRIF, so let's say you do it at age 65 or 67, every year, depending on the person's age, CRA says you have to withdraw a minimum percentage. Now, the interesting thing is that that percentage tends to be higher than what the lifetime withdrawal amount is for this plan. So let me show you guys. Okay. and don't look at these numbers here because that might be confusing. But look at this. So let's say we have a client who started their RRIF withdrawals at age 72. The lifetime withdrawal amount, based on the lifetime withdrawal amount, is what Empire Life guarantees as part of this plan. We've already discussed that. Based on their income base was 164K. Multiplied by 4.4 is what the lifetime withdrawal amount is for Empire Life at age 72. The client would be entitled to receive this much annual income. Okay, and of course you can draw it on a monthly basis, but this would be what the annual income would be. But based on the client's age, CRS says this client has to pull out 5.28% of the market value. So in this case, Empire Life will pay the higher of the two. So it would be either the higher of the RRIF minimum as stated by the government, or the lifetime withdrawal amount. Okay, so okay, and the income base, and the reason this the income base was lower in this case is because in the meantime the market value of the investment has grown, and keep in mind they only reset the income base every 3 years. So this was based on the previous year income base. Okay, the income base hasn't yet caught up with the market value, but because the government mandates that the client has to pull out of the RRIF at least 5% of the 5.28% in this case of the market value, you know, Empire Life will top up this LWA to equal the RRIF minimum. Okay, so you as a client, you really, in my view, you always win in this case, because they would pay you that RRIF. And the amazing thing is that normally with a normal RRIF, once you've exhausted your savings, you've exhausted them. But in this case, they will continue paying you for life. Empire Life, I know it sounds crazy, but they will continue paying. So whatever that last market value is that they reset to, and now the RRIF minimum says it's 5.8. Okay, whatever the RRIF minimum is, and every year it goes up. And in fact, I could let me see if I can show you guys. I'm gonna pull up a different screen here for a second. I hope I'm not losing you in okay, where is this? Okay, this is the RRIF minimum schedule. So as you can see, the older the client is, sorry, let me actually stop share. I want to share my other screen with you. RRIF minimum. So as you can see, the older the client is, the higher that percentage is. So even though Empire, as part of their product offering, says, well, you know, we'll pay you 4% per annum starting at age 65 and up to 5.28 at age 80. If your investment is inside a RRIF, they will pay you whatever the RRIF minimum is for life, even if your own investment by then has become exhausted. It's very interesting. So it really does away with retirement risk. So in that case, they will base it on the last reset value of the LWA, and of the income base. They will base it on the last reset value of the income base and keep paying you the RRIF minimum. So look at this, the older the client is, that RRIF minimum can be, you know, it really can provide a good additional stream of income at times when other investments may have been exhausted already. Okay, unfortunately, because you know, the older the client is, the higher the risk with traditional investment that you could be outliving your investments. So let me go back to my slides here. We're almost done, guys. Okay. Okay. All right. Okay. So again, this is an example where the RRIF minimum payments are higher than what the guaranteed lifetime withdrawal amount was for this client, in which case the client It says here, withdrawals up to the RRIF minimum do not count as an excess withdrawal and will not reduce the income base. Very sweet for the client. This is another interesting option with this client. So you can actually name a successor annuitant. So in the case of two spouses, you could have the spouse named the successor annuitant. So in other words, income will now be paid to the surviving spouse till the end of their death, to the end of their life. Okay, very interesting. It says here, successor annuity other than spouse can be named in a non-registered policy. So what we've seen happen is that somebody would name their child, for example. They could have a child that's in their 50s, become the successor annuitant after the parent, who was maybe in their 80s or 90s, has passed away. Very interesting, and it's a way to essentially carry forward the benefits of the plan to the next generation. And again, if you wanted to explore any of this in more details, I would encourage you to get in touch. I have access, and again, I would have loved to have one of our specialists with us, but unfortunately, compliance, they're technically only allowed to deal with advisors directly. They cannot speak to the public. So I just wanted to kind of give you a teaser, give you an idea of what's available. If the idea of a guaranteed income for life is something that either you or somebody in your family likes and could potentially benefit from, don't be shy. Feel free to reach out to me, and together with my specialist, we could do a custom illustration based on, okay, do you want to look at $10,000? Do you want to look at $15,000? What is your age? How old do you think you want to be when you want to take money out? All these illustrations we could run for you. So again, these are just some of their brochures, but again, we could do a custom illustration, and you can have a look and see if this is something that could enhance your overall planning. And so that brings me to the end of the presentation. Thanks, all of you, whoever has been watching. Thank you for watching. Thank you for being with me today. I'm gonna go on Facebook now to see if there are any questions. Okay. Where is my Facebook? Okay. 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 I don't see any questions, guys, but as usual, should any questions come to mind, please feel free to put them in the comment section, and I will be happy to address them later. Okay. Thanks again, everyone, for watching. I wish you all a great rest of the week, and look forward to staying in touch as usual. Okay. Blessings. Take care.